Today, the New Zealand property conundrum. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian and today a New Zealand flavour too. Before I start, a quick reminder that on Tuesday at 8 p.m. Sydney, I'll be running our next live stream Q&A event. This week, we'll be discussing the thorny question of investing, not trading, in the current complex environment. And I'll be joined by Damien Klassen, the Head of Investments, and the team from Nucleus Wealth to answer your questions following this week's announcement of a wealth solution tie-up under the Walk the World banner, but powered by Nucleus Wealth. So mark your diary and join us on Tuesday as we examine the current and expected trajectory of the economy and the markets. Today, I want to focus in on New Zealand. And first, a quick shout out to all our Kiwi followers. Appreciate your engagement with the channel. Whilst I cannot pull deep survey data on New Zealand like here in Australia, there are a number of critical events this past week. Reports that a flood of returning New Zealanders would help to prop up the economy appears to be overstated, at least so far. The latest figures from Statistics New Zealand show that just 1,861 New Zealand citizens returned long-term in September, which was less than half the 3,793 that returned in September last year. However, there was also a significant decrease in the number of New Zealand citizens leaving long-term compared to a year ago, with departures dropping from 2,915 in September last year to just 284 in September this year. That means there was a net gain of just 1,577 New Zealand citizens in September, up from the net gain of 879 in September last year. However, that small addition to the population was substantially reduced by a net loss of 769 non-New Zealand citizens in September, down from a net gain of 7,312 in September last year. So overall, that means that the economy's total population gain from migration was just, wait for it, 808 in September. That's down 90% from the net gain of 8,190 in September last year. Population growth from migration dropped hugely after the borders were closed in late March, crashing from a net gain of 11,277 in March to just 89 in April. And numbers have picked up just a little since then, but remain well below the levels that existed pre-lockdown. And in fact, over the 6 months from April to September this year, there was a net population gain of just 2,513 people from migration. That compares with a net gain of 29,709 over the same 6-month period last year. So although migration is still contributing to population growth, it's doing so at minimal levels compared to previous years. And this, I think, will be an economic drag ahead. And talking of economic drags, beyond that, the Reserve Bank's monetary policy statement called out that the severe economic effects of the pandemic were persisting and have significant implications. Both headline and underlying inflation were below 2%. Inflation expectations were subdued, and employment was assessed to be below its maximum sustainable level. In addition, closed international borders meant service export industries such as tourism would operate well below capacity for a prolonged period. Meanwhile, economic activity in other sectors appeared resilient, they said, with labour shortages re-emerging in some cases. The committee agreed that the assessed maximum sustainable level of employment may continue to be lower than otherwise, while the economy adjusted to the virus shock. Some members noted that resources could take a considerable period to be redeployed, which could result in isolated cost pressures. Others emphasised that underutilised labour from some sectors could put downward pressure on wages and inflation. Members discussed the outlook for inflation and employment. Staff presented a baseline scenario conditioned on a number of assumptions, including that there were no further substantial community outbreaks of COVID-19 in New Zealand and that the international borders would likely be open by 2022. In this scenario, the labour market was projected to weaken further in the near term, but it was projected to recover over subsequent years, in particular after the border was assumed to be fully reopened. inflation was projected to fluctuate around the bottom of the committee's 1 to 3% target range until late in the projection period. Committee members agreed that risks to the baseline scenario were less skewed to the downside than they had appeared earlier in the year, and economic outcomes could be stronger than assumed if households or business spending accelerated, for instance due to an earlier partial border reopening or a higher propensity to consume out of household wealth. The latter could be supported by higher housing and finance asset prices or improving sentiment about the global health outlook and its management. Members agreed that recent news from vaccine developments were promising, but that there were still challenges to overcome before widespread availability would be achieved. Members agreed, however, that it was still the case that unpredictable events could push inflation and employment significantly lower than in the baseline scenario. They discussed events such as ongoing virus outbreaks, delays in border reopening, and continued reluctance to invest by businesses due to general uncertainty. The outbreak of COVID-19 and the related containment measures caused an unprecedented fall in GDP globally. In the June quarter 2020, GDP fell by 12% in New Zealand, the largest fall on record. And New Zealand's key trading partners also experienced significant falls in GDP. The impacts in China were earlier than in other countries, with growth recovering in the June quarter. But in New Zealand, the decline was broad-based across sectors of the economy, and revenue for many businesses fell sharply. Nevertheless, the fall in economic activity was not as severe as expected, based on their previous scenarios. The containment of COVID-19 in the community allowed restrictions to be eased sooner than they'd anticipated, and firms also adapted better than expected, with more people working from home and firms doing more business online. Earlier this year, the government announced a $62.1 billion package to support the economy through COVID-19. Much of the spending was front-loaded in the form of wage subsidy and other transfers to households and businesses. Many of those initiatives have helped businesses keep people in their jobs despite lower revenue limiting the ongoing economic impacts of the decline in output. However, the wage subsidy has largely come to an end, with only a few hundred jobs still supported at the end of October. The impact of this support ending is unclear, they said at this stage. Some further job losses seem likely, but the number of people receiving unemployment support has been stable despite many people coming off the wage subsidy. In New Zealand, house prices have risen significantly over the past 2 decades. High house prices in New Zealand largely reflect structural and regulatory issues in New Zealand's housing market. In particular, land usage restrictions, such as urban planning rules, limit the land available for housing and how intensely it can be used, they said. These land restrictions impede the ability of the market to increase the supply of houses when demand for houses increases. As a result, house prices tend to increase more than otherwise in response to higher housing demand. Other supply-side issues include infrastructure planning, the building consent processes, and the cost of building. In the context of these supply-side issues, they said, significant population growth, mainly through immigration, has contributed to rising house prices in recent years. Migration is likely to be a factor in the recent acceleration of house prices. Well, hang on a moment, that doesn't chime with the data we saw before. This reflects that some New Zealanders who were living overseas returned home in the early stages of the COVID-19 pandemic, and fewer New Zealanders have left. More recently, net migration has been low relative to pre-COVID-19 levels. Lower interest rates have also contributed to rising house prices. A general decline in the level of interest rates since the early 1990s has been matched by an increase in prices of assets that provide future income or other benefits, including houses. Low interest rates are a global phenomenon and reflect the fact that the level of interest rates needed to match savings and investment in the economy has declined over time. These developments have been largely outside the control of central banks. They said, well, hang on a moment, really? Surely low interest rates is something that they have been manipulating, and of course much looser credit standards as well. I think the Reserve Bank here is walking away from its core responsibility. They have caused the home price problem. Now, they said, the upcoming November Financial Stability Report will contain a more in-depth discussion of the financial stability considerations relating to household debt. Well, I can't wait for that, but I suspect, again, they will blame everybody but themselves. And in fact, house prices rocketed up to new records in October on the back of cheap mortgage money, thanks to the Reserve Bank and the thirst for property. Indeed, according to the Real Estate Institute of New Zealand, the national median selling price hit a record high of $725,000 in October. That's an increase of $36,000 or 5.2% in a month, and up $120,000 or 19.8% since October last year. In Auckland, the selling price median increased by $45,000 in the month of October, rising from $955,000 in September to $1 million in October. That was a 4.7% increase in the month and a 16.3% increase for the year. For the rest of the country, excluding Auckland, the median price increased from $585,000 in September to $600,000 in October, up 2.6%, putting it ahead by 15.4% compared to October last year. Record median prices were set in Northland, Auckland, Waikato, Bay of Plenty, Gisborne, Wanganui, Wellington, Marlborough, Canterbury and Otago. The strength of the market was underscored by strong sales volumes, with 8,830 residential properties sold in October. That was the highest number of properties sold in any month of the year since May 2016, and the highest in the month of October since 2006. In Auckland, 3,140 properties were sold. That's up 50.9% compared to October last year. That was the most properties sold in any month of the year since March 2015 and the highest for the month of October since 2003. Properties were also selling more quickly, with the median days to sell dropping from 34 days in October last year to 29 in October this year. However, RBNZ Chief Executive Bindi Noel raised concerns about the effect the surge in prices was having on affordability in Auckland. While this is a significant milestone, it raises serious questions around future affordability for Auckland residents wanting to get a foot on the property ladder, she said. And the Reserve Bank, without admitting their error, is scrambling to react as they announced a series of further regulatory steps to, quote, promote cash flow, confidence and stability. First, the Reserve Bank said it would delay the start date for increases in bank capital, which were previously announced, allowing banks continued headroom to respond to the effects of COVID-19 and to support the economy more generally. The changes mean the increase in the prudential capital buffer will not begin until July 2022, and the Reserve Bank will reconfirm this timing nearer the end of 2021 and will consider making further amendments to the timing if the conditions warrant it. Other aspects of the capital reforms will proceed from the 1st of July 2021, including the new rules around capital instruments. They said this delay supports other actions the Reserve Bank has taken to cushion the initial economic blow of COVID-19 by promoting cash flow and confidence in the financial system. The Reserve Bank's actions throughout this period have promoted monetary and financial stability and provided broad support to the government, financial institutions and New Zealanders, Reserve Bank Deputy Governor and General Manager of Financial Stability, Jeff Bascott said. COVID-19 has emphasised the importance of buffers in the financial system. The more capital a bank holds, the better it can weather economic storms and meet customers' needs during tough times. Hang on a moment, but they're not increasing capital. There's something weird there. Delaying the implementation of parts of the capital review decisions by a further 12 months strikes the right balance between providing more headroom for banks to support lending now by drawing on their capital buffers, while also ensuring that capital levels lift in the longer term to support financial stability, he said. And the Reserve Bank remains committed to increasing capital requirements in the medium term to underpin financial stability. Next, the Reserve Bank will consult on loan-to-value ratios, the LVR restrictions, thinking in particular about the reinstatement of loan-to-value restrictions on high-risk lending with effect from 1st of March 2021. LVR restrictions are used to reduce the risks to financial stability from higher-risk lending. The restrictions were removed in May to best ensure credit could flow and that they did not have an undue impact on the mortgage deferral scheme implemented in response to the COVID-19 pandemic. Circumstances in the lending market have since improved, and we're now observing rapid growth in higher risk investor lending. We will consult about reinstating the restrictions we had in place pre-COVID, which limited the amount of high-risk lending that banks could make, Bascard said. Then the Reserve Bank is also announcing that the restrictions on dividends and redeeming non-common equity Tier 1 capital instruments put in place in April 2020 will be retained until the 31st of March 2021 or later if required. This will continue to support the stability of the financial system. And finally, the Reserve Bank has also written to insurers to advise that its updated expectations on dividends. The Reserve Bank expects that insurers will only make dividend payments if it is prudent for that insurer to do so, having regard for their own stress testing and the elevated risks in the current environment. Now, those proposed reintroductions of LVR limits is in response to, frankly, some pretty irresponsible lending in recent times. The bank clarified it wants to put restrictions back on bank lending to both residential property investors and owner-occupiers. RBNZ Deputy Governor and General Manager of Financial Stability, Jeff Bascard, confirmed the RBNZ intended to reinstate the restrictions that we had in place in April before we removed them. Specifically, he said that this meant there'd be no more than 5% of a bank's investor lending could go to borrowers with deposits of less than 30%, i.e. most investors need a 30% deposit, and no more than 20% of owner-occupied lending could go to borrowers with deposits of less than 20%, meaning most owner-occupiers need a 20% deposit. Why? Because, to quote, we're trying to stop all high-risk lending. When we had no restrictions before 2013, we were seeing a lot of lending going to 85%, 90% LVRs. The problem is this. If the housing market does take a downturn, and we certainly expected that earlier under the pandemic, he said, then people are exposed and they suffer losses, and then the banks suffer losses. We're trying to keep those credit standards up for everybody. We see a little bit more risk with investors than we do with owner-occupiers, which is why we've tightened the rules for them. RBNZ data shows a spike in high-risk lending to both investors and first home buyers following that removal of the LVR restrictions last May. The uptick has also coincided with mortgage rates falling on the back of the RBNZ cutting the official cash rate to a record low, as well as it effectively pumping in up to $100 billion of newly created money through the banking system via its quantitative easing programs, and it's planning to lend up to another $28 billion to banks at a low rate to help them lend on at low rates. Asked at a press conference on Wednesday why the RBNZ couldn't implement LVR restrictions sooner than March to prevent buyers rushing into the market before then, Governor Adrian Orr said, "We expect the banks themselves to be the ones who are lending responsibly and managing that capital allocation and avoiding undue risks." And he went on to say that the RBNZ also has to go through a proper consultation process. But note, though, the RBNZ only left a week and a half between proposing to remove the LVR restrictions and making their removal effective on May the 1st. And now, just a few months down the road, Orr has said that every bank CEO and a number of bank chair people were asking him to put the restrictions back on. You'd have to ask the banks why they couldn't do it themselves, but I'm assuming it's because of the competitive nature of banks. No one bank felt they could afford to step out for fear of losing market share, he said. And Orr said the decision was made by the RBNZ, which wasn't influenced by Finance Minister Grant Robertson, who made a point of telling media he'd brought forward a meeting with Orr on Monday. And he then welcomed the RBNZ's LVR announcement, saying, "I would like to see the work happen as soon as possible." Just bear in mind, RBNZ announced it would provide banks with $28 billion of cheap funding, and it would be asked about the impact of this on the housing market. The concern we have is only about high-risk lending, they said. We obviously don't have a mandate and we don't control the housing market. The housing market is a consequence of all sorts of supply and demand factors. But knowing that the Reserve Bank is moving to reinstate loan-to-value ratios has the main banks keen to fall into line. The first bank to do so was ASB. It said it was moving immediately to increase the minimum deposit required by investors in the wake of the Reserve Bank's Wednesday announcement. ASB's Chief Executive Officer, Victoria Sorrett, said ASB believed a balanced and sustainable housing market is in the best interests of all New Zealanders. While we appreciate the RBNZ taking the time to consult, this is about helping Kiwis build their financial futures during exceptionally challenging times. So we are choosing to take this step now. Short said that the lending market has improved markedly since New Zealand went into its first lockdown. COVID-19 hasn't impacted the property market as anticipated, and ASB is now witnessing rapid growth in lending volumes. The number of applications we're receiving is at an all-time high, up 70% on this time last year. And while the proportion of first home lending is up, we have observed since COVID-19 a rapid increase in lending for investors. If this increase in investor demand continues, it could lead the country down a potentially unsustainable path, she said. Our focus at ASB is on working with the government on offering first home buyers opportunities to get into the property ladder. That's why we're immediately committing to require investors to have a 30% deposit rather than the current 20%. Pre-approvals already in place are unaffected. And the performance of the housing market is not consistent with an economy in the midst of the worst recession in 100 years, and a circuit breaker is needed, Kiwi Bank economists said. Commenting on the latest super hot housing figures from the REIA, Kiwi Bank senior economist Jeremy Kuchman said double-digit price gains during the worst recession in 100 years just does not pass the sniff test. He said that Kiwi Bank economists were now no longer picking a correction in New Zealand house prices for either this year or next. He noted that credit growth among other higher risk borrowers is accelerating. A circuit breaker is needed, and the Reserve Bank has delivered that with the likely reinstatement of LVR restrictions. Although, to be clear, the RBNZ is not focused on house prices, but heading off a surge in high-risk lending. Cashman said the strength of the housing market and the rate of credit growth out of lockdown has surprised everyone. Numerous factors are behind the phenomenal rebound in housing market post-lockdown. In the housing market post-lockdown, he said, including record low mortgage rates, the removal of LVR restrictions, and the distinct lack of listed property. An earlier return of the macro-prudential speed limits through the LVRs is warranted, he said. The speed limits will come back into play from March the 1st. Cashman said, but given how banks' speed limits are measured, the handbrake on new high LVR lending approvals and lending will start to be pulled much earlier than March. Banks generally give pre-approval for loans for 90 days. Knowing the restrictions are coming in March, banks may start tightening up in December and January. Tightening of LVRs will most likely fall hardest on investor-related lending. And since April, lending growth for investors has shot up, particularly to higher risk investors, defined as those with equity of less than 30%. Couchman said that while the Reserve Bank of New Zealand looks to have turned the heat of the housing market down a notch or two with LVRs, he says that the RBNZ has also added more monetary policy stimulus this week. And I guess that's my point. A very hot housing market in New Zealand has been created by ultra-low interest rates and ultra-loose lending policies. And people are now calling out the risks that have been created, and yet the mitigation strategies are weak and delayed. So I expect to see considerable further growth in house prices in New Zealand now over the next few months, followed by a significant reversal. And of course, if they are right in projecting higher unemployment and a continued drain on the economy because of the after effects of COVID-19, then some of those house prices could certainly be reversed over the next year or two. It seems to me that they have created a bubble on a bubble, and that bubble is likely to burst, but not immediately. I'd give it at least 6 to 12 months. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.